Welcome to Online Trading Campus. This is Jan Skoropinski with you today, continuing the new 2020 Forex course. Welcome back to Module 1, Fundamental Awareness. Lesson 3, Forex Lingo. This is the agenda for today. To communicate and trade Forex effectively, we need to know the Forex-specific language. There'll be a lot of key terminology we will cover today, including Forex pairs, pips, lots, pip values, spread, how to read Forex pairs, and lastly, rollover. A currency pair is a single trading instrument which consists of two individual currencies in the spot market. We have what is called a base currency. This is the first currency in the pair with a value always equal to 1. And we have a quote currency, or the quoted currency, which is the second currency in the pair. And the exchange rate, the exchange rate is the amount of the quoted currency it takes to buy 1 unit of the base currency. In this example, we need 1.18372 US dollars to buy 1 euro. If an exchange rate is 1, the official term for this is parity. Parity is when two currencies are worth exactly the same. So if we need 1 US dollar to buy 1 euro, Euro USD would be at parity. If an exchange rate is above 1, the base currency has a greater value than the quote currency. Or in other words, in this example, the 1 euro has a greater buying power or is more expensive or stronger than the US dollar, because with 1 euro you can buy approximately 1.18 US dollars. If an exchange rate is below 0, the base currency is less valuable or weaker than the quote currency. Or in other words, for example, the current New Zealand US dollar exchange rate is roughly 0.65, meaning for every 1 New Zealand dollar, you can only buy 65 US cents or 0.65 US dollars. In this example, you can see 5 decimal places. I want you to focus on the 4th decimal. In all but yen pairs, the 4th decimal place is the so-called pip. That will be important once we start pricing these currency pairs. For yen pairs, the 2nd decimal place is the so-called pip. Now, a pip or percentage in price is the smallest price change or increment in price we as traders will look at. Even though it is not actually the smallest increment, now the engineers in the room will rightfully say, well, but you know what? I can see 5 decimals. Yes, absolutely. The 5th decimal place is called a pipette. However, pipettes are so small, 1/10 of a pip, that this can be ignored or rounded depending on the setup. Understanding the location of the pip is important for us to calculate how far a currency pair has moved. So here's the slide that probably makes the most sense. In all but yen pairs, the 4th decimal place is the pip. So 1, 2, 3, 4. Every move up or down on this decimal represents 1 pip. The 3rd decimal, 10 pips. The 2nd decimal, 100 pips, and so forth. For yen pairs, the 2nd decimal place is the pip. 1, 2. Every move up or down on this decimal represents a 1 pip move. The 1st decimal, 10 pips, and so forth. Now, there are 3 different types of lots we can trade in the spot market. So-called lots are a unit of measurement, similar to contracts in futures or the amount of shares in equities. For currency pairs, this is just called lots. There are 3 different types of lots: a standard lot, a mini lot, and a micro lot. And depending on the ones chosen, you would either increase or decrease your risk or position size. If I'm buying a standard lot, I'm buying 100,000 units of the base currency. If I'm buying a mini lot, I'm buying 10,000 units of the base currency. And if I'm buying a micro lot, I'm buying 1,000 units of the base currency. An important differentiator from broker to broker can be the way on how this is displayed. With equity, 1 is a standard lot, 0.1 is a mini lot, and 0.01 is a micro lot. So for example, in equity, when I'm buying one standard lot, I would type in the number 1. Below, you can see the required margin for this trade, which is $1,183.94. Now, margin is like the down payment when you go out to buy a house. Let us say the house you're looking at costs $100,000. You only have to pay 10% as a down payment, meaning your margin would be 10% and your leverage to buy this house would be a 10-to-1. In Forex, it is similar, even though the margin is much better here. This would be an example for a 1% margin and a 100-to-1 leverage. Let's look into this. So buying one standard lot of Euro USD means we buy 100,000 units of the base, 100,000 units of euros. Buying at 1.18406 means we would buy 100,000 euros or $118,406 worth of euros. With a 1% margin, I only require 1% of the units purchased. Therefore, 1% of $118,406 is $1,184. Here it shows $1,000 and $183.94, which is just about the same. Don't worry, we'll go into the specifics of margin and leverage in more detail later on. For now, I just want you to understand the concept of lots. Lots are the tradable units. Standard lots is the biggest lot size. Mini lots are 1/10 of a standard lot, and micro lots are 1/10 of a mini lot. So in this example we've just done, if we were to trade 1,000 units or 0.01 with equity, we would only buy 1,000 euros or $1,183 worth of euros. This is ideal for beginners as it allows for small and flexible position sizing, as the different lot sizes can also be combined. For example, we could trade 1.31 lots depending on the risk size we want to achieve. With futures, you're not as flexible as you're trading futures contracts. So let us put it all together to get to the so-called pip value. The pip value is calculated by taking the amount of units traded multiplied by the price of the currency pair. For currency pairs with US dollar in the quote, like the Euro US dollar, Aussie US dollar, British pound US dollar, this is quite simple. Trading one standard lot, every 1 pip price increment on a US dollar quote pair represents $10 of pip value. Trading one mini lot, every 1 pip price increment on a US dollar quote pair represents $1 of pip value. Trading one micro lot, every 1 pip price increment on a US dollar quote pair represents 10 cents of pip value. When we then talk about cross pairs, depending on the strength of the pair that is shown as a quote currency, the pip values change. For this lesson, I want to stick to the foundational topics. Plus, our life is made very easy because with equity, we have an integrated pip value calculator right here. For Euro US dollar, you can see the pip value for one standard lot is $10, while for a cross pair like Aussie New Zealand, the pip value is $6.56. As a result, we should understand what a pip value is and how it is calculated. However, don't worry, we do not have to calculate it ourselves. Alright everyone, let's go through a little bit of a practical application to really drive home pips, pip values, and potentially also lots and how we put it all together. So let's first look at the Euro USD chart and really try to understand, first of all, pips, okay? And what I'd like to do here, I'd like to really go down to a small time frame, a 1 minute chart. And I just want to see what's happening on the right axis. And let me just zoom into current price. So right now what you're seeing is current price of the Euro US dollar constantly moving, right? We're seeing a price of an exchange rate of 1.18120. And up here is an exchange rate of 1.18130. So if price moves from here to here, that's the equivalent of 1 pip move, because the fourth decimal represents 1 pip, right? So it would go from 2 here to 3 and then to 4. So this would be 2 pips. This would be 3 pips, right? This would be 1, 2, 3, 4, 5 pips, and so on and so forth. And you can also see the 5th digit while price is moving. That's the pipette, but that's, 1/10 of a pip. That's extremely small. We can kind of neglect it. Now also keep in mind, we're looking at a 1 minute kind of chart. So as I'm squeezing this, you can now see we're now making 2 pip jumps. All right, 1.1812 to 1.1814. Now this is 2 pips, then again 2 pips, again 2 pips. I can squeeze this again. Now this is making 5 pip jumps. So from 1.182 to 1.1815. This is 5 pips. I can further squeeze this. Further. Now it's 10 pips. Okay, so from 1.183 to 1.182, this is now 10 pips. Why? Because the third decimal represents 10 pips. So every move in the third decimal is 10 pips. So 10 pips up, 20 pips up, or from 1.1810 down to 1.18, again 10 pips down, 20 pips down, 30 pips down, and so on and so forth. So if I now go to a daily chart and I zoom out a little bit, you will now see different kinds of moves, right? You will now see 100 pips. Okay, so from 1.17 to 1.16, this is 100 pips, right? Because the second decimal represents 100 pips. So every move in the second decimal represents a move in 100 pips. And for example, if I now talk about 1,000 pips, this would be from 1.1 all the way to 1.2. From here to here, this would represent 1,000 pips. Okay, so far so good. So this right axis always gives us a little bit of a helpline, a little bit of a guide on approximately, you know, how much has price moved or how big are our zones. We can use that as a guide. So let's first look at demand. And there's a very easy way on how to calculate pips in general. And I'll show it to you in a second. So let's just say, you know, we are going to determine this as demand. There's a rally, there's a base, and there's a rally here as well. So already what I can see on the right side, well, this goes from 1.12 to 1.14. So not as much. I mean, just roughly, right? Just roughly speaking. I mean, 1.12, 1.13. This would be 100 pips. So it must be just over 100 pips. All right. So probably 120, you know, 130 pips maybe. So what we're gonna do now, very, very simple. For demand, what we're doing is we're just taking the distal and we're subtracting the proximal from it. So we're gonna say proximal minus distal. This in general is how you calculate the pips for demand. And then you would have 1.13274 minus 1.11686. And we would just quickly get the calculator out, and you guys can do this as well. I'm gonna give you some time to punch this into your calculators. .0.01588. Okay, so in pips, this means that we've got 158 pips and 8 pipettes. Why? Well, the fourth decimal is 1 pip, so I've got 8 pips here. Third decimal is 10 pips. Well, I've got 5 here, so this is 50. And the second decimal is 100 pips. I've got 1, so 100. 158 and 8 pipettes, and the 8 pipettes we would just round up. So 159 pips right here. Now let's look at supply. Let's say we've got a little bit of supply up here. All of this, we're gonna take all of this into account. And I wanna really understand how many pips of price movement is between the proximal and the distal. Well, easy. First of all, I can kind of ballpark it, right? I could say, well, it goes from 1.26 to 1.24 roughly. So it must be 200 pips or just above, right? Just above 200 pips. So what I'm gonna do for supply, it's the opposite way of looking at it. So it's now the distal minus the proximal. So how you can remember this, always use the upper line first and then subtract the lower line from it. So demand, it's proximal minus distal. Supply, it's distal minus proximal. So here it's 1.25591 minus 1.233. How many threes? 3333. Now I'm gonna give you some time again to punch this into your calculators to see that we've got the same kind of results. I made a mistake here. This should be a 1. All right, now go again. So here we are getting 0.2258. And in pips, 0.02258. And in pips, this would be 225 pips and 8 pipettes. So again, I'm rounding this up, which is 226 pips. So quite easy. I've got this zone, we set it already, we ballparked it, 226 pips. We've got this lower zone, 159 pips. And then the next part is gonna be a little bit more difficult, but actually also quite simple. If you're now gonna spin the wheel further and you're gonna say, well, what about, lot size and then pip values and how much money could 159 pips be? Well, 159 pips, if you're trading this with a standard lot, then 159 pips could be $1,590 of risk right here. But it could also be $159 or $15.09. Okay. Now we know that for the Euro USD, the pip value is $10, right? How do we know that? Well, USD is the quote currency, so all pairs with the US dollar as a quote, it's gonna be $10. So, right, this is now our web trader on equity. I punch in 1. This is a standard lot. I can see the pip value right here. It's $10. I could put in a micro lot. I see the pip value is 10 cents. I could put in a mini lot, and I know the pip value is $1. So I know that my zone on the euro is 159 pips. I know that the pip value is $10. So I'm just timing this times the amount of in terms of pip value, whether I'm trading standard lot, mini lot, or micro lot. Now for a standard lot, it would be $10, and I would be getting in a dollar amount $1,590. Now this is quite a lot, right? This would be quite a lot, but that's why we have, that's why we have a mini lot and a micro lot, because now with a mini lot, all of this now becomes 159 pips times $1. So then this would become $159. Maybe $159 is still intermediate. Maybe this is still too much in the beginning. So we could be trading micro lots. So with micro lots, it would really be 10 cents in terms of pip value, meaning I would only risk $15 and 9 cents. Okay, and the same would apply for the supply. Basically, if I trade a standard lot times 10, so 2,260. If I trade a mini lot times 1, 226. If I trade a micro lot times 0.1, which is going to be $22.6. All right, so pretty simple. I just want you to understand kind of the mechanics. Okay, I want you to understand, okay, pips, price measurement, how do I read it? How do I, get a ballpark number from just looking at the chart and looking at my price axis? How do I understand the width of the zones, and how does this relate to potentially risk size and position size, depending on the lot size I'm trading? The lots are the units. Standard lot is the biggest, mini lot is the one in between, and micro lot is the smallest. And to understand that, I also need to understand the pip value. Now for all USD quote pairs, all the currencies where I've got US dollar as the second pair, as the quote currency, my life is really simple, because I know it's always $10 for a standard lot, $1 for a mini lot, and 10 cents for a micro lot. However, if I've got cross pairs, like for example GBP JPY, GBP out, Euro out, USD CHF, or even exotics like Mexican peso, USD Mexican peso, USD Turkish lira, what I'm gonna do is simply, I have my web trader, and regardless of the currency, even here GBP ZAR, if I'm gonna punch in one standard lot, I'm gonna get the pip value in my account currency, because it's got an integrated pip value calculator right here. So that makes my life very, very easy. USD CHF, for example, again, what's the pip value for a standard lot? Okay, $10.97, easy. What about CHF JPY? What's the pip value here? Punch in 1. Okay, $9.36. Now we need all of this to kind of, to calculate our position size later on. However, equity also has an integrated position size calculator down here. We'll talk a little bit about this once we proceed and at a future date. So let's go back to the material and talk a little more about some further key terminology. Now, if you place an order on equity or an order on any other broker, it is basically the electronic instruction to the broker to enter or close a position. That should be clear by now. So if you place a limit order to buy, you are by definition a willing buyer. You are bidding to buy below current price. If you place a limit order to sell, you are basically a willing seller. You are asking to sell above current price. Now the difference between the two is the so-called spread. Remember what we talked about in the first lesson? This is what your broker charges. This is your cost of doing business. But here's the interesting part. As we now know, every currency pair is quoted at two different prices. And how brokers will display this to you depends on the broker themselves. This is what the equity web trader looks like. Here it actually says buy and sell, but look at the prices and compare them to the bid and ask prices to the left. This means that the buy button to the right shows you the ask price, meaning that if you are buying, you will be filled at the ask price. Notice that the ask price is above the current price of 1.18171, which is the bid price. So you're basically paying 1.5 pips in terms of spread or premium to the broker. So where it says ask, this is the price you're watching for your buy order to be filled. And vice versa, if you're selling, you will be filled at the bid price, meaning the sell button to the right shows you the price at which you can sell, which is the bid price. So where it says bid, this is the price you're watching for your sell order to be filled. I want to tell you this because I want to eliminate confusion going forward. You can take this to the chart level, even with Rwanda, for example. You can opt to show bid, ask, or even an average price chart. So you could see your price levels literally being hit on the pip, but your order would not be filled because maybe you're looking at a different price chart, not taking bid and ask prices into account and how they relate to you being either a buyer or a seller in the market. Therefore, we need to know what we're looking at when we want to be a seller, and we need to know what we're looking at when we're a buyer, especially when we're in the business of daily income. The lower the income type, the lower the time frames, and therefore the more accuracy we need as traders. With equity, it always shows the bid price. So when we look at our bracket orders later on, I will show you exactly how to manage spread. Now, before we continue with more key terminology like rollover, let us quickly understand how to read a chart in general relating to base and quote currencies. Now, right here you can see a Euro US dollar price chart. From 2018 to 2020, Euro US dollar dropped massively in value. That means that the pair was becoming cheaper. The base currency becomes cheaper compared to the quote currency. Or in other words, you need less of the quoted currency to buy 1 unit of the base currency. Then from 2020 to today, Euro US dollar rallied massively in value. That means that the pair is becoming more expensive. The base currency becomes more expensive compared to the quote currency. Or in other words, you need more of the quote currency to buy 1 unit of the base currency. Simply put, from 2018 to 2020, the euro value became weaker in relation to the US dollar. And from 2020 to today, the euro value became stronger in relation to the US dollar. Therefore, when we go long on the euro US dollar, what we are really saying is go long the euro and go short the US dollar. And when we say go short on the euro US dollar, we are really saying go short the euro and go long the US dollar. This is some fundamental understanding on charts, which is going to be more relevant later on once we talk about cross pairs and correlations between different currencies. I will show you exactly how to use this to achieve the following scenario. Something I mentioned in the first lesson also. We want to trade the weakest against the strongest currencies linked together in one instrument to achieve the biggest bucks for our dollars. Now let us talk a little bit about rollover. This will be the last key term we will learn for today. Rollover is offered by brokers to give us the opportunity to extend the settlement date to the next day without receiving actual delivery of the currency. Rollover occurs every weekday at 5 p.m. New York Eastern Time. And that's also broker dependent, so check that with your brokers. This is just equity. When rollover occurs, traders either earn or pay interest, depending on interest rates associated with each currency of the respective pair traded. Now, this also happens over the weekend, so we don't just earn or pay 5 days a week, but 7 days a week. This usually happens on Wednesday, 5 p.m. EST, as the broker will assume you're holding this over the weekend, if holding from Wednesday to Thursday. Therefore, on Wednesday, you will either be debited or credited 3 times the daily rollover amount. Now here's a little nugget for you guys. The most important rollover of the week is Monday, 5 p.m. EST, because it represents the first closing price of the week in New York. This will give us a good reference point on whether the price at which a currency pair is trading at any point in time is either bullish for the week, if trading above the reference line, or bearish for the week, if trading below this reference line. I will show you this once we go into practical applications. Basically, we will start placing a line in the beginning of the week at 5 p.m. EST, and this will stay for the entire week. This will help us understand and anticipate potential market turning points within big picture supply and demand context, but also it will help with trade management when trailing some of our open trades. Let us do a little bit of a practical application on this, looking at the Euro US dollar daily chart and maybe also on a lower time frames, and back testing what we just talked about Monday rollover 5 p.m. EST. So what we're going to do is, first of all, I want to see the price points where price has really managed to make to change direction. Basically, I want to look at pivots, and I want to understand, first of all, looking at these pivot points, how this Monday 5 p.m. EST line held up, and I also want to look at what's happening today. All right. So first of all, let's zoom into this one right here. And we also have to go down to a lower time frame at that point just to understand where 5 p.m. really comes into play. Okay, so up here, and then I'm just putting a vertical line in. So anywhere from 9th of March to 8th of March, 8th, 9th, 10th. Okay, let's just check the calendar to see where Monday was. So I'm going back to March and 8, 9. Okay, on the 9th we had a Monday, and on the 2nd we had a Monday. So we probably have to look at the 9th here. And then I'm going to look at the 9th because the 2nd is only, way to the left. I'm going to look at the 9th, and I'm going to try to find 5 p.m. And for this, I'm just checking this box here, show time. So now I'm at 20 p.m. I want to get to basically to 5 p.m. right here. So this candle represents 5 p.m. Okay, so what I'm doing is at that point in time, we would put in a horizontal line right here, and this would become our anchor point for the week. Okay, as New York Exchange is closing for the first time in the week and basically telling us if we are trading above this, it's bullish. If we're trading below this, it's gonna be bearish. So soon later we trade below, and you can also see as we trade below, we never come back, and this is making a reversal. Okay, so then we trade below, this would be bearish, 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 and then we never come back. So this can give us a great anchor point to really understand whether we want to be bullish or bearish for the week. Now let's look at this lower area to see if here maybe this tool, the Monday 5 p.m. EST, would have also told us that price is likely to turn within big picture supply and demand context. So now again, I'm taking my vertical, I'm putting it over to the right, and now I'm talking 23rd, 24th, 19th, and let me check where the Monday was again. So back to March, 23rd, okay, and 30th is our Monday, 23rd and 30th. So 23rd, I'm right here at the 23rd already. Now let me find the 5 p.m. mark right here, 5 p.m. okay. So we can also see, as this is rolling over the next week, as we're trading above that 5 p.m. close, this is turning again direction and is becoming bullish. All right, it's becoming bullish. And what we also see, this sort of became demand, demand and support as well, right? And as long as this area then is held, obviously this is very, very bullish. So price is changing direction here as well. And this was again our anchor point to tell us within higher time frame supply and demand, if this is happening, then we can expect at least for a week either bearish if it trades below or bullish if it trades above. So let's look at today what's happening now to get a better understanding. So right now it's the 14th of August. If I need to look at the Monday, it would be the 10th. Okay, so let me get my vertical line, put it over to the 10th right here, and I also want to see the 5 p.m. mark, which is just about here. Okay, just about here, roughly. So what am I seeing? I'm seeing that price for the week should still be bullish, okay? Because this line, this our anchor, was our anchor for the week. We traded below real quick, but price couldn't really close below. Price bounced back. So below this line is a lot of support or demand, you would call it. So as long as we hold this, as long as price is trading above, it's gonna be bullish for the week. Now next week on Monday, we are gonna obviously have to look at this again, and then if at some point this is rolling over, we'll see it first on Monday and on Tuesday with our anchor point right there. And in the process, then obviously we would see weekly reversals and the daily reversals and all of that good stuff. All right, let's go back to the theoretical part and finish off rollover. Rollover in general has its benefits because we can hold longer term positions without having to worry about contract rollover like in futures with back and front months. With Forex pairs, there's no expiry. However, with every yin, there's also a yang. Depending on interest rates for respective currencies, longer term trades can be extremely expensive. For example, shorting the USD CHF. Whether we are debited or credited rollover depends on the currencies we're trading and the interest rates linked to those currencies, which are set by the central banks. Rollover is also sometimes referred to as swaps. This is how it generally works on a very, very high level. Central banks will set an interest rate which are attached to the currencies. When we trade currencies, we either buy or sell them. In other words, we earn interest for the currencies we buy and we pay interest for the currencies we short. Now, since most currencies today are close to 0% or even sometimes at -%, most brokers will have various calculations and arbitrage costs in place for them to make money on almost all scenarios. To understand the cost of rollover, most brokers will have those listed on their website. For equity, simply follow the link here, which will give you a full list of all the currency pairs, including the daily rollover charge or earnings for both long and short positions. Interest is based on a standard lot and is shown in the currency of the quote currency. Longer term positions will have to be calculated on a 7-day week basis. Let's sum up rollover with a little bit of a risk management exercise. The risk for rollover is very low because it's manageable and you're able to calculate the risk. Trading some currency pairs can be costly, yes, especially when trading exotics or pairs with negative interest rates on a weekly or monthly income basis. However, as long as we understand the additional cost implications and ensure enough profit potential is given, we should not shy away of opening a new position. Some Forex specific actions we should include in our trading routine are as follows. Check and understand additional rollover cost implications and ensure enough profit potential is given before entering a trade. Counter trend trades that are costly should be avoided. Costly trades only with clear and ideal big picture context. Understand that if stopped out, total loss may be higher than position size calculation due to rollover. Historically and traditionally, rollover interest could be used in our favor. We want to trade currency pairs in the direction we benefit the most from in terms of interest, so-called carry trades. When carry trade trends form, they tend to be very strong. However, this is now rapidly changing due to the zero and negative interest rate policies which central banks around the globe are following. But we will talk about this once we get there. Alright everyone, today we've once again covered a lot of Forex lingo and key terminology to get everyone on the same page. With this lesson, we also concluded Module 1, Fundamental Awareness. Up next, Module 2, Beginner, Lesson 1, Global Forex Markets. I will catch you all for the next lesson. Until then, happy and safe trading and ciao.